Hi, everyone. This is Rohit from Rise of Mastery, and today I'm excited to have Joseph Dormani, who's the founding investor principal at Thomson Reuters Ventures. Thomson Reuters invests into early stage enterprise technology companies out of the $100 million corporate venture fund. Joseph has done his MBA from Fordham School of Management. Welcome to the show, Joe.
Thank you very much. Excited to be here.
Awesome. So you've been into the venture space for quite a long time. How did you get into this crazy world of venture capital?
Yeah. It's been a bit of a long journey for me. I feel like whenever anyone asks this question, other folks that I've heard have like this really like serendipitous story that they, founded this amazing company and then became an amazing investor. After that, my story is a little bit longer, a little bit more of a grind. Professionally, I always knew that I wanted to work in venture. I've taken a very long time and sort of done all the things. Like if you were to read a book that said, here are the 10 things you have to do, I sort of tried to do all 10 of those things. So I worked at a startup, did some consulting. I went back to school to get my MBA, focused on financial skills. I worked in product. I worked in strategy, did some M&A, got the corporate experience, and then sort of when the opportunity hit me to join a corporate VC, it was kind of a situation where I couldn't be told no, because I'd done all the things to prepare myself skills wise to be in a position to do that. So yeah, I mean, it's been about 10 years on that journey, but now I'm happy over the last about year to be in a position to invest in startups.
Interesting. And how did you get an opportunity with Thomson Reuters?
Yeah, so it was super interesting. So I luckily at the time that I was doing my MBA, they had this summer associate program where you could you'd spend your summer working for Thomson Reuters in a rotational program as part of their, it was called the MAP program at the time. And I joined that in my summer between year one and year two of my MBA. And what I remember, the funny story that I remember from that is that in my interview process, you had to sort of interview the winter before the summer that you started, and the day of my interview or was like a blizzard. And so I went to do my interview, and then I heard or read somewhere that writing handwritten thank you letters was a good way to show your enthusiasm. I really wanted to work at Thomson Reuters. So in the blizzard, I had written like 7 handwritten letters, and I was like determined to get to the office. And I got to the office in the middle of a blizzard to hand in my handwritten letters, and they were like, well, nobody's here. It's a blizzard. You can't go upstairs. And I was like, all right, well, I'll just leave them with the security. And then I found out later that they'd already made the decision after, before they had gotten the letters. But so it was a little bit of a funny story. But yeah, I was lucky enough to join TR for my summer in between year one and year two, and then I joined them full time in the 2-year rotational program after that, working in different parts of the business. It's been a super interesting opportunity. I've been with the company now 7 years, and it's the kind of company that if you work hard and like ask to do interesting things, they like work really hard to put you in a position to do those things. So been pretty grateful.
Yeah, no, I love the story about handwritten letters. I think listeners who want to get into VC firm, they should look into your lesson. What are some of the core objectives of the fund? What's the thesis of the fund?
Yeah, so I mean, you mentioned it up top. It's a $100 million enterprise technology fund. We're a financial focused fund, so we're focused on returning the fund. The added benefit with us is that we're a strategic fund for the corporation, and what that means is we invest in and around the markets that we operate in. So legal tech, tax software, fraud, risk and compliance, news and media, and then technologies that are highly applicable and interesting for those verticals like machine learning, natural language processing, task process automation, all things that we have a strong thesis around as being central to the future of professionals. So the objective is to return the fund, but also invest in companies that are strategic to the future of the company and the markets that we serve and our customers. we're kind of hands-on folks, so we like to work with the companies that we invest in. So a big part of what our team does is we work to drive the connections between the companies we invest in and the teams in the different parts of the business. It's a big value add for us.
Got it. And when it comes to corporate VC funds, do you think they they are viewed in the same way as traditional VC, or I somehow sense a view that they're not viewed in the same way? What are your thoughts on this?
Yeah, I mean, it's an interesting question. I think couple of things. I think when I take a step back and think about what I see in the kind of, I'll call it the traditional venture space and versus the corporate venture space, I actually think both of those different groups are trying to be a little bit more like the other, right? So the more traditional VCs are actually just adding more to the scope of what they do. Some of them are building out development operations. Some of them are building out portfolio support, which is a longer term trend, but something that is becoming more prevalent. And I think they're trying to do some of the things that actually a corporate VC is pretty well suited to do, right? Well, we have engineering teams, we have product teams, we have a lot of subject matter experts who can help us evaluate companies, who can help us do some of the strategic things that we want to do when we're looking to make investments and accelerate the companies we invest in. And then, we're investing off the balance sheet, right? So, we don't have to deal with some of the stuff around capital calls and working with LPs. Like, obviously, we in our fund have the solo LP. We have Thomson Reuters. We have stakeholders in the corporation who, it's important that we operate with, but we don't have to worry about like I said, capital calls and things like that. So yeah, I mean, there are certainly differences, but and on the corporate VC side, one of our big objectives is to bring insight into the corporation. It's a big part of what we do, but we're all also working towards having an operating mechanism that enables us to move fast independently and kind of operate at the speed of the startups that we're investing in, which is something that the traditional VCs have kind of it's sort of native to the way that they operate as well. So that's on both sides, like I said, kind of trying to take the things that the other does really well and incorporate them into your core model.
Got it. And where does the future hold for corporate VC? Do you think there'll be an expansion of this capital source in the next coming years, especially with big companies like Amazon and Apple also coming up with their own VC funds, corporate funds?
Yeah, I mean, hard to say what the future is. I think that there's a ton of value in doing it if a corporation is in the right position. You have the right stakeholders bought in within the corporation. You have very clear objectives for why you have a corporate venture arm and what you're trying to achieve with it. So for me, it makes a ton of sense why a corporation operating from a position of strength, looking to get access to new technology, new innovation, and being willing to make venture bets to do that. It makes a lot of sense why we would do that. I think ultimately I see it continuing to expand, especially when there are more and more examples of different companies that can do it well, and the sort of reputation of those companies continues to kind of get known in the market. And what I actually hear from companies often is that they're actually looking for strategic investors. Most of the companies that I speak to are looking for more than just capital. And a lot of corporations are oftentimes in a good position to be able to bring that, as long as they have a specific thesis. They're very targeted in their focus in terms of the markets that they focus on, the technologies that they know they want to invest in, so that they can bring a point, very strong point of view when they're making an investment decision. Which is something that we strive for. I think we do a pretty good job. We have a pretty good reputation in the market that we operate in, the markets we operate in, from our customers for sure, and just the market more broadly. So, with those conditions, I see it expanding. Of course, just like in traditional VC, the corporations that try it and aren't able to do some of those things, they're not going to be as successful. And so, some of that will fade away, but net, I think mostly expanding.
Got it. And I've seen a lot of startups hiring head of corporate development. You've been you've been part of corporate development for Thomson Reuters. Why do you think a lot of startups are hiring corporate development guys, and are there any signals when a startup should start hiring somebody in the corporate development team to acquire maybe more companies?
Yeah, I mean, so it's interesting. I don't know that I have observed this directly. I think maybe more so happening in some of the later stages than what I generally look at. But that being said, I quite like the idea of thinking about M&A a little bit earlier than might be the consensus of what the right time is, which I'm actually not sure what the right time is, but I think thinking about it on the earlier side of things, if you're trying to establish a market position and there are smaller technology companies out there that you could purchase along the way that can help accelerate you, that align with your roadmap, technology is somewhat compatible and not going to take a ton of effort to integrate or have to re-architect. I actually like the idea. We just see so many companies that, when from my vantage point, you see companies that are solving very specific problems, which is really important at the early stages, especially to being able to be successful, gain traction with customers. But there's companies that are often solving really important adjacent problems, and sometimes I just want to say, you guys should meet and think about how you might combine efforts, and some of what we do on the partnership side. So I think if I were talking to a founder and trying to say, we're trying to talk about what might be important on the corporate development side, I might say start with partnerships. Start with partnerships because it helps you establish a cadence of looking into the market, working with people, and ultimately could lead to a position of strength to potentially be an acquirer as you mature. And it's kind of one of those things where it's the right time when you kind of feel it's the right time organizationally, which I know is a little soft, but I think it's probably hard to say exactly what the right time is.
Yeah, no, absolutely. And you did mention about acquisitions. So especially when it comes to late stage startups, when how should they assess the attractiveness of acquihires, and what's the framework to acquire a company?
Yeah, I mean, so it's a good question. I think the way that I like to think about it is, does the acquisition accelerate what you're trying to do, right? And there's there's plenty of ways to frame that up, but some of the ways to sort of think about that is, like, what's the most efficient use of capital, right? Like, if you are going to trying to develop something organically, but by doing that, it limits your capacity and bandwidth, and you have a comparable capability, or there are some folks in the market that about that have a specific set of expertise that it can help you do that faster. You have to sort of evaluate the cost and time that it will take you to develop that capability organically versus just paying to take that in inorganically through that acquihire. So it's a sort of classic build buy question. And I think it ultimately comes down to the product strategy and the roadmap and what your target customers value the most, what you want your core competency to be, and what's okay to be complementary to that core, right? And you kind of want to prioritize and build the things that you think are going to be your core differentiators. And you can think about acquiring or acquihiring things for things that are supplemental to that.
Got it. And especially when it comes to talent acquisition, what are the essential characteristics of individuals when you're looking into in these acquihire situations? Because a lot of these acquihire situations, you actually taking the entire team along with you. So are there any characteristics you look for when you're looking to acquire a company?
Well, so I mean, couple of things there. And I think there are specific things that we look at for acquiring or investing in a team, and then there are specific things that we look at for acquiring or investing in a company.
Right.
And obviously there's an overlap there, but I'll try and take them one at a time. I mean, when it comes to the team, we like to see, assuming it's a capability buy, which in most cases it is when we're thinking about, an acquihire, we want to see specific expertise. We want to see relevant experience solving similar problems, right? It doesn't have to be in the exact space, but, something that is similar, like, enterprise technology, but in a different vertical is fine. The expertise is somewhat fungible in a lot of those cases, but specifically a couple of things about like founding teams that I think are super important, especially on the technical side. Having had some sort of experience where they felt the problem that they're trying to solve, or have experience translating customer problems to solutions, something super important that we look at. So having specific expertise in that regard, because if you sort of like felt a problem like yourself, then you're pretty well suited to try and solve that problem, or at least have a really strong understanding of what the problem is and where it kind of lies in. So having what we call founder market fit, right? So having a founder that's specifically well suited to solve the problem that they're trying to solve. And then the other thing that I think is super helpful that I look for pretty often is just clarity of thought, right? So the ability to articulate the customer problem that they're solving, how their solution solves that customer problem, and even being able to have the kind of mental plasticity to talk about different aspects of the business. So being as fluent in the technical aspects of the product as they are in some of the financial details of the business. Like they can tell you, down to very specific metrics, what the current state of the business is, how many customers they have, how many customers they added last month, how much revenue they were able to get on board, where that came from. Was it new customer acquisition? Was it expansion of existing customers? Just you can tell when there's someone who's kind of firing on all cylinders, and it's usually a pretty good signal for success in being able to build and scale business. For like larger scale investments or M&A, we focus a little bit more. We focus on the founding team and bringing that in, and we think about it in a couple of different perspectives. For M&A, TR is always looking to bring people into the business that can take on bigger roles within the company, and we also look to take some of our best people and put them into the companies that we acquire. We think it's important to drive cross-culture contamination. Maybe contamination is not the right word, but cross-culture molding or mixing. But we're very metrics driven when it comes to both M&A and investing in the fund. So we're looking for companies that are fast growing companies, especially on the VC side. When we look at a company, we're looking for software companies that are growing fast, have a differentiated product, being efficient from an investment standpoint and a sales efficiency standpoint. We love to see net revenue retention at a sufficient level in the 110, 20, 30, 40% range. Yeah, I mean, so we're very, very metrics driven when we look at investments. We think about the companies we want to invest in.
Interesting. Yeah, I absolutely agree. I think the front of market fit and clarity of thought is really important, and the founding teams can add a lot of value to what the acquirer is trying to build. Especially when it comes to CEOs, when they're trying to add the corporate development team, are there any mistakes they make when they're looking to hire corporate development guys? And something they should be aware of. Like should they hire somebody from a banking background or an investment banking background, or from a consulting background?
Yeah, I'm not sure it matters a ton. I think what is important is there are a couple of things that are important. I mean, you have to have a technical background to some degree, I think, to be successful and to be able to operate at a good cadence. So whether it's consulting, investment banking, or getting the skills in any other number of ways that you can get those skills, I think it's fine. What I think is probably most important is having someone who is willing to learn an industry, and some expertise in a specific industry that you want to go after and acquire in is important. But I think the ability to learn that market, understand the market dynamics, who are the acquirers, who are the companies getting acquired, is it a fragmented market, are there a couple of incumbents that represent a majority of the market share that are rolling up the smaller players, like what the ability to understand that market from both a kind of investment side, but then also from a technology side, like what is happening in the market that's driving market growth, what is happening in the market that customers are happy with, where are customers seeing gaps, the ability to kind of break that down and understand where a market could be going, super important. So the technical skills, the ability to break down a market like that. And then you have to, I think one thing that is super important is being able to come at the conversation from all of those different angles, whether it be the market, the product, the technology, the customer angle, and being able to have a conversation from any one of those angles with the various stakeholders in the business to explain to them where they sort of fit into this M&A and then integration equation. I think that's the invaluable piece that separates someone who's good from someone who's great.
Got it. Interesting. And I want to understand about unit economics, especially when it comes to enterprise software companies. How do you assess unit economics when you're looking into investing into those companies?
Yeah, I mean, there's some degree of pattern recognition, I guess, that we look at, but we have our own playbook on this stuff. So we're basically looking at this Series A stage. We're looking for indicators of product market fit. So we like to see a sufficient level of revenue, right? We're investing in a way that we want to make sure our company gets from Series A and is able to grow to a place where the company has an attractive profile for the next investor, for us to potentially do a follow on. So we want to see accelerating growth, accelerating traction. We want to see ARR, and so annual recurring revenue accelerating, right? Monthly recurring revenue accelerating month over month. And we want to see the product being pulled out of the company and them having to hustle to keep up with demand and not having too long sales cycles and taking a really long time to convert leads to customers. One of the, obviously we look at retention, both from a gross and net dollar retention standpoint. We look at customer retention. We look at all the sales efficiency stuff, right? So customer acquisition costs, how long it takes to get paid back from that. We look at magic number, so new ARR in a period divided by the sales and marketing expense from prior period. And ideally for that, you want a number that's greater than 1. Okay. I think there's generally a perception that sometimes in the early stage we care less about margin. I don't think that's consistent. I care a lot about margin. I think it's okay if the current state of the business, the margin is not where you want it to be, but I think you want to understand that as the business scales, the margins get to a place where the business will become sustainable, profitable, and generate free cash flow. I feel like that should be not overly controversial, but maybe isn't. Maybe more so now, but maybe over the last few years was not as much at the forefront of what was on folks' mind. So yeah, margins important. One, we want to make sure there's capital efficiency, and we love to see engagement in the product themselves. So we always talk to customers when we we look at investments, we want to hear what they're doing with the product, how they're using, how often are they using it? Is it daily? Is it monthly? Is it like core to a workflow, or is it somewhat adjacent to what someone is doing in their daily life and their daily tasks? So, it's kind of that playbook that we kind of try and fit every company that we look into and try and evaluate them based on, what we see as attractive in those different categories.
Very interesting. And especially when it comes to the burn multiple, how does the burn multiple change with the stages of the business? Especially when they're looking at raising Series A and Series B. How would you advise founders on what should be the burn multiple?
Yeah, I mean, I guess what I would say is the way I would think about that is you should be managing your business to achieve things that are specific and measurable, right? So I think what I would and what I'd also say is the best person to determine what those are generally, the management team and the founder of the company. So I would say be very intentional about the goals that you set to hit, and raise as much money as you need to reach those goals, and make sure that those goals like match up with each other, so that the profile of the business is attractive, and not just like for the next investment, which obviously I care about a lot and think is really important, but also as a way to attract talent, right? Like if you're going to be, operating a company that's, you're issuing some equity options and grants, you want to make sure that valuation is in line with those options and grants that you're issuing, and that the company performs well, so that those options turn into value for your employees, so you're able to keep them. So I mean, there's all different types of benchmarks out there, but I think the kind of more important thing is, be intentional about what you plan your milestones to be, communicate what those are, and then use the money that you think you need to achieve those milestones. And if you do that and you execute on it, you should be just fine.
Got it. And especially during these times of market downturn, how would you advise founders on aggressively to cut down burn, so that they could have a longer free way to work on the business?
Yeah. Well, I guess some of what we were saying just in the beginning is, in the earlier stages of company building, I'm not sure how relevant the current economic climate is to building companies. Like, I mean, it's obviously relevant because we're all living in that world, but I think there are pros and cons of there being, bull and bear market cycles, right? Like in a bull market, it's hard to find good talent, right? Because all that talent's being sucked up by, all the different companies that are getting all different types of funding and growing rapidly and all that. So, and it's hard to get mind share, right? With everything going on, but in a bear market, some of that stuff starts to loosen up, and as you build your company, you're building it through adversity. So you're kind of inherently building a company that is resistant to negative economic outlook. And so these things always seem to happen in cycles. And so as you're building a company, if you remain focused on building something that the world values, building something that solves a problem that customers want, I don't know that current economic climate is going to stop you ultimately from being successful, especially if it's something technology related, right? One of the things that becomes more important with inflation is the need for productivity, right? And so technology is a massive driver of productivity. So if you're building something that's going to have to help with that, even in kind of negative economic times, there's still going to be demand for that, right?
Right. Interesting. And Joe, quickly want to do the top three. What's your favorite business book?
Yeah. So I spent a lot of time reading business books. I know some people say that they never read a business book. I love them.
Right.
So I spent a lot of time there. I think that the one that has been most impactful to me, the one that I enjoyed the most, is The Hard Thing About Hard Things by Ben Horowitz.
Yeah, no, I think that's a super book. And if you could go back in time when you started working at Thomson Reuters, what is one thing you would have focused on or done anything differently?
So I think the one thing that I'm always jealous of is people's ability to like create something out of just typing things into an interface. So I think I would spend a little bit more time learning how to code. I'm like, it's something I've been kind of working on in my spare time, and it's like one of those things, like you kind of pick it up and put it back down, but you really need to kind of like practice to be good and like create anything of value. So I think that if I were to do it over, I would spend a little bit more time on learning Python.
Yeah, no, I think it holds true for me as well. I don't know how to code. The only thing I know how to do is to work on my WordPress account. But do you have any favorite online tool? For example, Gmail, Slack, Zoom.
Okay, this is going to be boring, but my favorite tool is Excel, and I'm not going to apologize for it, but that's my favorite. I honestly tried to come up with a better answer than that, but I love Excel. So
yeah, no, I think it's a pretty useful tool. I need to learn how to work on my Excel skills better. We'll take some tips from you. Joe, what is the best way people can reach out to you and know more about Thomson Reuters?
Yeah, so you can come to www.tr.com/VC. And so that's Thomson Reuters Ventures website. You can shoot me an email at joe.dormani@tr.com, or you can check me out on Twitter at Joe Dormani_VC.
Awesome. We'll put that in the show notes. Joe, thank you so much for taking your time speaking to us. I really enjoyed my conversation with you.
Yeah, thanks very much for having me. It's been a pleasure. Really enjoyed the conversation.